Okay. In this video, we are going to talk about some introductory concepts in income and income tax, specifically in India. Income tax, and India. Now, first thing we have to understand is the concept of a financial year, which is basically a one-year period which starts from 1st April of the year to the 31st of March in the succeeding year. So 1st April 2009 to 31st April 2000 to 31st March 2010, right, would be financial year 0910. Now, basically the income that would have to be considered is the income earned during a financial year. And the income tax would be the income tax that is paid on that income. Now let's think about the different types of income. We have regular income and capital gains income. We will deal with regular income first. Regular income consists of salary income, which is basically your salary from your job. You have rental income, which is income earned as rent either from commercial or residential property that you've rented out to people. Third, you have business income, which is the income earned from a business that you are running, which can be either the sale of goods, like in shops, or sales of it could be a service-oriented business. The key thing to remember is it's not the total volume, it's not the total revenue that you have gained in your business, but it is the income less expenditure. Right, it's the net income that we're talking about for business income. And finally, we have a catch-all category called other income, which are things like interest on bank deposits, or in fact any other kind of interest, dividends from shares. It could be things like sitting fees, that is the kind of the fee that you're paid by a company if you're on its board for attending their meetings. It could be gambling income. It could be any kind of miscellaneous income from things which don't come into the other categories. Okay. Now, capital gains income is basically income which is the profit or the loss generated from selling items that you have owned. Now, it can be, this is an income which can be both, just like business income, it can be a loss also. You could, for example, be selling something at a lower cost than what you bought it for, in which case you generated a capital loss. Now, capital gains in general can be divided into two types of capital gains income. There's the short-term capital gains income and the long-term capital gains income. And this basically relates to the length of time which you have owned this property before selling it. Now we'll go into all of these in great detail in succeeding tapes. Okay, now the general flow of how income tax is calculated is as follows. We have regular income, and we have deductions, which are allowances given by the government to reduce your regular income to take care of things such as expenses involved in earning that income. And what you're left with is the taxable regular income. Now this goes into a box in which the income tax rates are specified, and you can get out the result of that is the actual income tax, the regular income tax to be paid. We'll deal with all of these boxes separately. Now similarly, you have capital gains, cap gains income, and that also has its own set of deductions. And you get taxable capital gains income, which goes into its own box. It's calculated. There are various rates, and the output of that is your capital gains income. Now these two income taxes are added together, and this is your total income tax. Your total income tax, then you calculate the surcharge or cess on the income tax, which is usually, in India at least, it is basically a 2% and a 1% charge meant for educational purposes. So effectively what it does is it adds 3% to your total tax, and you add these two together and you've got your total income tax due. Now in India, your income tax is not paid all as a lump sum at the end of the year. You pay as you go, the system basically. So various people who provide you the income are asked to deduct a certain amount and pay it directly to the government on your behalf. That is called tax deducted at source. So this amount of money is paid directly to the government on your behalf. Then to make up for the total income that is due, you may have to sometimes pay advance tax. For example, if most of your income comes from sources which do not deduct this tax at source, you have to pay your advance tax. And then if there is any leftover amount, that would have to be paid at the time of the return. Balance tax. Now if you're a salaried person, most of your tax is deducted at source. If on the other hand, if most of your income is from other income, then almost all of it has to be estimated by you and paid as advance tax. And if there are any discrepancies in the total that is actually due to the amount that has already been collected, you would pay that at the time of filing your return. That would be the end of lesson 1. Now we're going to deal with each of these boxes in detail in succeeding tapes.